And the reason really is because we didn't do the groundwork in that whole period leading up to the crisis. I think people were far too content with the way things were. People weren't really pointing out the astonishing growth of the state. I think public spending went up by about 60% in real terms under 13 years of the last government. I've never actually checked this factoid, but it's been told to me, it sounds cool, so I'll repeat it to you, that no state in history has grown that fast as a percentage of GDP, except Weimar Germany, and we all know how that ended up. So we weren't making enough noise about the growth of the state. We weren't really preparing the ground to make arguments for scaling it back, and we didn't really have the tools at our disposal to explain how that could happen. Similarly, I think that libertarians really were far too content with the banking system, with the financial system, too prepared to say that this was indeed, as the film Wall Street would have us believe, the kind of pinnacle of free market capitalism. And I'm going to come back to why that probably isn't true. And I think the upshot of that is that when the crisis happened, even though libertarians actually had a lot of the answers, right? Even though Austrian economics provides a very compelling explanation of the crisis, even though kind of free market policy thinking can solve or explain a lot of the things that we're trying to do now, we didn't really have the credibility to make serious headway. And actually, if anything, I think we've lost ground over the last couple of years, even if, yes, we have more opportunities to advance more radical arguments. So I think that the challenge from here, how do we advance liberty, how do we make use of the kind of political situation we find ourselves in, is really akin to financial trading. You have to try and work out how the market's going to change, how things are going to shift, and then take a position that will allow you to profit from that when it happens. And obviously there are risks involved in that. No one can predict the future, but we can make, I think, some educated guesses. Now I'm going to talk about two areas where I think that there will probably be more crises, rather like the ones we've just had, and where I think there will be significant opportunities to advance the cause of liberty. Now the first one is banking and the financial sector, right? And now I'm about as free market a guy as you could ever possibly meet. I'll fight anyone in a free market battle, because I'm right up there at the extreme fringe. But don't let anyone convince you that the banking sector and the financial system that we have at the moment is free market, because it isn't. And I'm not going to go into all sorts of anti-capitalist rhetoric. I think a lot of people who maybe kind of have the same opinions as me on this get into that trap. They think, well, say something extreme and anti-capitalist and everyone will like us more, but they're not really doing themselves any good. The big problem with banking is a fairly simple one. First of all, the government subsidises the banks to take risks. That's inherent in everything the government does to do with the banks. It's inherent in the fact that we bail them out when they go wrong. It's inherent in the fact that the Bank of England is constantly lending to them so that they don't have to maintain such large reserves, so they can basically take on more risk. And you can actually measure this subsidy if you look at the kind of risk premium that's charged on bank debt compared with other equivalent corporate debt. Bank risk-taking is subsidised. Everything we have set up by the government to do with banking encourages banks to take more risk than they would in a free market. Now, government then tries to deal with that problem through regulation. They say, well, okay, we're making you more risky, so we're going to have to try and control your risk-taking activities so that it doesn't all blow up in our faces. Now, they do this largely through capital ratios, liquidity ratios, all kinds of regulations. The basic effect of those, though, is completely the opposite of what they hope for. The basic effect of financial regulation is to make all of these banks who are desperate to take risk take the same risks at the same time because they're complying with the same regulations and they're meeting the same capital requirements and liquidity requirements under the same international legislation. Basically, you have a system which is set up to be risky and unstable, and then you have regulation which ensures that those risks become systemic. And when a crisis does occur, everything goes wrong at the same time. Now, this is a crazy system. We've had one crisis because of it, and everything we've done in reaction to that crisis at a political level, at a legislative level, actually compounds the problem and makes it worse. More bailouts, more capital regulations, more things which are going to encourage regulatory arbitrage, which is to say decisions being made on investment which are based on getting round regulation, so piling into derivatives because they're accounted for in a different way, which flatters your balance sheet, rather than doing things which are maybe more sensible and safer. Now, all of those problems are basically government-driven. They're not to do with greed. I mean, most people are greedy, most people are self-interested. Of course, bankers are, maybe more than most. But that's not a problem in and of itself. It's only a problem if you have a faulty system. And we have a massively faulty system which will blow up again. And the answer to that faulty system is a free market one. It's about removing the government from the banking sector. It's about getting rid of the bailouts. It's about getting rid of the central bank. It's about getting rid of a lot of the regulations and actually making banks behave, again, like real capitalists. If they take risks, they bear the consequences, up or down. And with that kind of market discipline, I think you'll get a far more stable system and a lot less risk being taken. And that's the argument I think we need to be advancing, and I think we need to be making it very clear to people for when the next time the banks start crashing, and frankly it could be within the year, it could be within the next couple of years, it'll definitely happen though, just to make it clear that there is a free market answer to this problem, so that we're not left looking silly when it all blows up like we were last time. Now, point two is to do this time with the fiscal crisis and the welfare state. Now, I guess probably everybody here knows that we're out of money. You know, public spending, like I said, it went up 60% in real terms under the last government. The upshot of that is that we're borrowing about £20 million per hour, 24 hours a day, 7 days a week, all through the year, and we're spending about £120 million a day just servicing the interest on the debt that we've already got. So when you hear this stuff from UK Uncut and the Trade Union Congress and whatever, saying we don't need spending cuts, forget about it. Completely untrue. It's also untrue, by the way, that the coalition government is actually cutting spending by 81 billion, or indeed that they're cutting spending at all in any meaningful way. That 81 billion figure, if I can just have a quick aside, is basically based on a baseline which assumes that public spending goes up by 16% over 5 years. Now, any deviation from 16% growth counts as a cut in the Treasury's budget, and so 81 billion off 16% growth, well, if you work it out, it's not really a cut at all. But never mind. So we're probably going to get back to a more stable fiscal position if the government manages to stick to its plans. Fine. But that's only a short-term fix. Now, if we follow government plans up until 2010, and then we go back to doing what we were doing before, I think we go bust again in about 2019. Again, future predictions are difficult, but that's the kind of ballpark figure. If we share the proceeds of growth, David Cameron's old catchphrase, and we pay down a little bit of debt, but we increase public spending again as well, then we might go bust around 2035 or something, but we're still going to be in serious trouble. Now, the reason for this is changing demographics and the implications of that for the welfare state. Now, you've probably all heard of the baby boomer generation, the demographic time bomb. Basically, we've promised people universal healthcare free at the point of use for their entire lives. And we've got a lot of people who are suddenly getting to the age where they're going to need a lot of healthcare. Just at a time, by the way, when all kinds of new treatments and all kinds of new technology are emerging onto the market, so you have this incredible ratcheting up of the price of healthcare just when lots of people want to use it and you've got no money. That's a big problem. You've also got a problem with pensions, right? Pensions work on the basis of we who are working pay taxes to support people who are now retired and not working. That's fine when you've got lots of people working and not many people having pensions. When you've got a lot of people on their pensions and not enough people working, that becomes a very serious problem indeed. And there are all kinds of studies have been done, basically, on modelling what happens to our economy, what happens to the welfare state over the next 10, 20, 30 years or whatever. Assuming the demographic changes people expect come to pass, and assuming we don't change our policies, assuming we do everything that we've planned to, assuming that we honour every promise that we've made. Now, it's pretty horrific when you look at it. The Bank of International Settlements, which is kind of the central bank, do a lot of really good research. And basically, they forecast every OECD country up to, I think, 2040, maybe 2050, no, it's 2040, up to 2040, so over the next 30 years. Basically, if we stick with our current policies, we will have an accumulated debt of 5 times GDP by 2040. Now, considering we're probably at about 65–70% at the moment, that's an enormous change over the next couple of decades, or the next few decades. More to the point, it would mean we were spending a quarter of all of our economic output every year servicing the interest on the debt that we built up. So that's all the money from income tax, basically, all the money from corporate. It's pretty much all the tax, right? Then there'll be a little bit left over for one or two other things, but not very much.